The origins of the bubble can be traced back to Japan's economic miracle in the 1960s. With the technical and financial support of both local and American governments for post-war recovery, Japanese conglomerates gained huge success in their manufacturing industries in the 1960s. Japan rose to be the second largest economy of the world in 1967 with its large profits from exports, which further increased when Japanese companies developed innovative and efficient methods to improve the quality of their products. With a strong competitive advantage in high-value export products such as cars and electronics, Japan's standard of living soared that in the 1980s its GDP per capita rivaled or even surpassed many Western countries like Western Germany. But at the same time, this triggered vigilance of the U.S. government with respect to the great trade deficit it had with Japan. The U.S. initiated the signing of Plaza Accords to weaken the U.S. dollar against the yen and German Deutsche Mark, with an original aim to weaken the competitiveness of Japanese exports. The appreciation of Japanese yen unintendedly made foreign capital investments relatively inexpensive for Japanese companies and results in U.S. bond deficit. Adding up with the overconfidence and overexuberance in Japan's economy after the economic miracle, both local and international investors turned their investment to Japan, with the banks lowering interest rates in response to export shrinkage. A large amount of capital flooded Japan's housing and stock market in speculation, and prices of these assets were pushed to previously unimaginable levels. Starting to deviate against actual values, the skyrocketed stock and house prices formed a huge bubble. From 1985 to 1989, Japan's Nikkei stock index tripled to 39,000 and accounted for more than one-third of the world's stock market capitalization. Concerning the growing assets bubble, the Bank of Japan tightened its monetary policies by increasing the official discount rate from 2.5% to 4.25% by late December 1989. Then, both the housing bubble and the stock bubble popped that the Nikkei index tumbled from approximately 39,000 to 20,000 during the year 1990, hitting 15,000 by 1992. The burst of Japan bubble in 1989 brought severe recession to Japan's economy. Firstly, the Japan bubble decreased the land prices, which declined 1.7% from its peak. Average prices in 6 major districts dropped 15.5% from its peak, in which commercial land, residential land, and industrial land prices dropped by 15.2%, 17.9%, and 13.1% respectively. For example, a prime A property in Tokyo's financial districts had slumped to less than 1% of its peak. Tokyo's residential real estates were less than a tenth of their peak, which was a far cry from the day when the land prices in Tokyo were rumored to be worth more than all of those in California. Since the residential prices in largest cities dropped 64%, the substantial losses on the largest purchases were taken by millions of home buyers. Since Japan bubble decreases the property prices, balance sheets of most companies were wiped out. Thus, this crippled the nation's banks and blew the economy. Secondly, the bubble hit the stock market hard. The Nikkei 225 at the Tokyo Stock Exchange plunged from approximately 30,000 to 7,000, producing a loss of $2 trillion. Besides, because of the great drop of the stock index, investors turned away from Japan. The manufacturing firms found it difficult to uphold their competitive advantage. As a result, Japanese products became less competitive overseas, harming Japan's economy. Moreover, the Japan bubble made banks went into bankruptcy. In fact, most banks relied on the properties as collateral for loans. Due to the reason that the real estate values plummeted, the banks could not receive the loans back, and this resulted in losing money. Banks were then saddled with billions of dollars in debts. This was to say, the banks accumulated as much as $1 trillion in bad debts. Actually, bad loans were held mostly by companies which accumulated large debts and could not repay the loans. In this case, banks lent the company more money to prop them up. However, this increased debts and also causing the bank to enter risky ventures. Banks lost more money and went into bankruptcy. Last but not least, the Japan bubble badly affected consumer confidence. Since the asset prices tumbled and the liabilities increased, the balance sheet deteriorated and were presented as bad news for the investors. Also, Japan's corporation faced huge difficulties to reduce debt ratio. Consequently, this badly affected direct consumption and investment within Japan. Simply, there was a short decline in consumption but a long-time deflation. For this reason, consumers lost faith in the economy and the degree of consumer confidence decreased. To sum up, the Japan bubble affected the economy in three aspects: decreased land prices and stock index, as well as made bank went bankrupt and affected consumer confidence. As we may observe, there are four major similar points between Japan housing bubble and 2008 credit crisis. Firstly, deregulation in financial sectors provides regulation opportunities to speculative investments. During 1977 to 1985, Japanese governments and public bonds were securitized, and the interest rate was allowed to float. Moreover, as states in New Currency Exchange Law 1980, government will only interrupt exchange rates when there is an imbalance in balance of payments. While for U.S. backed in December 2000, President Clinton signed the Commodities Futures Modernization Act of 2000 into law, written by Congress with lobbying assistance from financial industry, which banned the further regulation of the derivatives markets. Also, in 2004, U.S. Securities and Exchange Commission relaxed the net capital rule, which enabled investment banks to substantially increase the level of debt they were taking on. Consequently, even professionals in financial sectors could not precisely tell the underlying risk of structured products, which are just complex portfolios with asset pools. Risks of derivatives are calculated with carefully designed formulae that nobody understood. However, investment banks didn't care what the products really were. The uncertainty of risks were ignored under the interest-driven nature of investment banks. Secondly, low interest rates is necessary to form the bubble and high interest to make the bubble burst. Because of the Plaza Accords, Japan was responsible of acting to lower the value of Japanese yen deliberately. Apart from selling the currency directly, Japan raised interest rates so that increased demand of yen could revalue it. However, high interest rates made it difficult for companies to raise funding to maintain production or to expand. Due to appreciated yen, Japanese exports were more expensive and harder to sell. Exporting manufacturers soon got into trouble, while domestic investors focusing more on the foreign capital due to higher purchasing power of yen worsened the situation. To resolve the concern, Japanese government lowered interest rates to encourage domestic consumption and make it easier to get financed. Unfortunately, instead of supporting manufacturers, low interest rates triggered investment demand and speculation in property market. Speculators held lots of yen after declaration of Plaza Accords. It is very stupid to bury the money in basements. They sought for opportunity to invest and get return. Both domestic and foreign speculation lift price of land and stocks. Japanese government was aware of the unreasonably high price and chose to use contractionary monetary policy to suppress speculations. Home buyers who could not afford the increased mortgage payments chose to default. Banks took back the collateral and attempted to sell them to recover the loans, which lowered the housing price. More and more people thought it was not worthwhile continuing the amortization, thus chose to default as well. Eventually, the bubble burst. Similar case happened in US. Lower interest rates encouraged borrowing. From 2000 to 2003, the Federal Reserve lowered the federal funds rate target from 6.5% to 1% to soften the effects of the collapse of the dot-com bubble and the September 2001 terrorist attacks, as well as to combat a perceived risk of deflation. As early as 2002, it was apparent that credit was fueling housing instead of business investment, as some economists went so far as to advocate that the Federal Reserve needs to create a housing bubble to replace the Nasdaq bubbles. The third similarity was lack of promising industry to absorb investments. At 1985, Japan urbanization rate was already 90%. The developing potential was not promising in the original industry structure. At that time, internet industry had not grown into main profitable point. Liquidity provided by the deregulation and the following securitization had nowhere to go but the stock and housing market. While for US, people calmed down after witnessing the dot-com bubble in 2000. Investors took a wait-and-see attitude while observing internet industry. Given low interest rates at that time, investors choose to enter property market and avoid risks and preserve value. Finally, it came to the stereotype of the never-dropping property price. Tokyo Olympic in 1964 promoted infrastructure construction in Japan, including the Shinkansen and JR. Well-developed international cities such as Tokyo and New York attracted huge population inflows with high average wages. Thus, demand of housing increased continually, supporting the prices. Severity of land gave people an illusion that property prices will seldom drop. Such past experience formed the stereotype of property prices in developed districts when there was no obvious promising industry. There are four possible signs for the next financial crisis. Firstly, the sign of reduced bank capital. There are lower capital buffer requirements in the 30 global systematically important banks, like Citibank, JP Morgan, and etc. In 2016, 2 banks are required to have 2.5%, which is the highest, and 4 banks to have 2%. But in 2017, only 1 bank remained in the 2.5% bucket, and in 2018, the bucket of 2% even worsened and decreased to 3 banks only. The statistics show that there is a tendency of having lower capital requirements ratio. It encourages banks to have over-leveragings, and if bubbles, they will have insufficient cash to pay back the investors, causing bankruptcy and a serious financial crisis like the Lehman Brothers holdings. Secondly, there is a sign that the stock market and exchange rates fluctuated abnormally and that defaults occurred frequently. The stock market and exchange rates are the major indicators of regional economic conditions. Once abnormal fluctuations occur, they often represent problems in economic development, and economic markets should be sufficiently vigilant. If it is accompanied by a social debt default and even a national credit sovereign debt default, it is likely to trigger a regional financial crisis. For example, the economic problems of Iceland in the past and now Turkey were caused by the collapse of the exchange rate and debt default, and further financial crisis will likely result. Thirdly, the sign that exports are blocked, domestic demand is insufficient, and economic transformation fails. Oil crisis happened in US led to the surge of energy price, which generated inflation. For the purpose of appeasing the upcoming financial dilemma and practicing the economic transformation, the US invited country to sign the Plaza Accords. Venezuela is also a typical example. When global energy prices plummeted, oil exports were blocked, domestic demand was seriously insufficient, and she was forced to carry out economic transformation. Once the transformation failed, the domestic economy went from bad to worse. Inflation soared. The exchange rate plummeted. The inevitable financial crisis will finally break out. Lastly, there's a sign that the asset bubble indicates watered economic growth and serious financial leverage. The outbreak of the financial crisis is often inseparable from the effects of overheating and asset bubbles. And the typical examples is that housing prices remain high. The global real housing price index increased from 145 to 162 within 5 years, which shows it increased much higher than inflation. Most people can't afford a house. Even if they can buy it, they will bear long debts. The real estate market can't create real value, but it stores a lot of social wealth, and the bubble is serious. All signs mentioned above may cause the next financial crisis. In order to prevent the next financial crisis, we should keep an eye on those important factors, observe the negative bubbles, and prevent them from bursting and ravaging the economy.